All right, let's jump right in. The market took a pretty serious nosedive this past September, and if you were watching your portfolio, you probably felt that familiar, sinking feeling in your stomach. Stocks were down, volatility was way up, and one massive question just hung in the air.
Was this just a healthy, totally normal pullback? The market letting off a little steam? Or was it something more? A warning sign of bigger trouble on the horizon? It's that kind of uncertainty that can make even the most experienced investors feel a little on edge.
So to cut through all that noise, we went straight to the source. We're going to break down an exclusive Ask Me Anything session, an AMA, with some of the sharpest minds in finance, what the industry calls key opinion leaders, or KOLs. We wanted to get you the real story.
Okay, so first things first, let's just set the stage. What exactly went down during that September market correction?
Well, it was kind of like a perfect storm. You had central banks making noise about interest rates, you had ongoing geopolitical stress, and some really key sectors just didn't deliver on their earnings. And the result of all that? A pretty significant correction across stock markets all over the world. Now for the big one, the why. What was really behind the dip? This is where it gets fascinating, because the experts we talked to really looked at this from two completely different but equally important angles.
First up, we have Miss Lynn Tran, who's a portfolio strategist. Her take is that this was mostly a technical correction. Okay, so think of it like a balloon that's been inflated just a little too much. This was the market letting some air out. It wasn't some fundamental breakdown, but more about investors taking profits and just rebalancing after a really long run-up.
But then you have macroeconomist Mr. David Chen, and he points to something totally different: psychology. He argues that the hawkish, kind of aggressive tone coming from central banks like the Fed and the ECB is what really spooked investors. It wasn't just about the numbers anymore, it was about the feeling that the safety net was being pulled away.
So you see, what's so crucial here is this dance between market mechanics and human mindset. On one side, you've got the market's internal plumbing doing its thing, algorithms rebalancing, people cashing in profits. But on the other side, you've got pure raw human emotion, fueled by fear and the powerful words of central bankers. Both were absolutely at play. And of course, there's a very modern twist to this whole story. Fintech educator Annika Patel pointed out how social media acted like a double-edged sword. Platforms like Reddit and TikTok, they just amplified the initial panic, making it spread like wildfire. But, and this is the interesting part, they also amplified the optimism that eventually helped the market find its footing again.
And all this talk about fear and panic brings us right to the psychology of a dip. Why does a drop in the market feel so personal and so intense? Let's dive into the brain science behind it all.
I mean, we've all been there, right? You see all that red on the screen and your heart just starts to pound. It turns out there's a very real scientific reason for that. It's actually rooted in how our brains are wired.
Behavioral economist Dr. Emily Nguyen breaks it down with this key concept: loss aversion. What it means is that psychologically, the pain we feel from losing $100 is about twice as powerful as the joy we feel from gaining $100. Our brains are literally hardwired to avoid loss at all costs. And this is where things get really dangerous for investors. During a correction, that loss aversion kicks into overdrive. It creates this intense, gut-wrenching urge to just sell everything. And that gets combined with herd behavior. We see other people panicking and selling, and we feel this overwhelming compulsion to do the same. These biases are always there, but a volatile market just supercharges them.
So, while a lot of everyday investors might be hitting the panic button, what are the big institutional players doing? Well, they're not running for the exits, not at all. They're making very strategic moves.
I absolutely love this quote from hedge fund analyst Mr. Hiroshi Yamamoto. He says, "It's not a retreat, it's a recalibration." See, the smart money isn't just selling off, it's rotating. It's re-aiming its capital toward where it sees the next big opportunity.
In this slide shows you that recalibration in action. You can see a really clear rotation happening. On the left, money is flowing out of those high-growth tech stocks and more speculative plays. And where's it going? Look at the right. It's flowing into sectors like energy and industrials. We're talking companies with tangible assets and predictable cash flows.
Okay, so we've covered the what, the why, and the psychology behind it all. Which brings us to the most important question, right? What does this all mean for you? What should a disciplined investor be doing right now?
What was really amazing was that across the board, every single expert at the AMA came back to these three timeless tools. First, dollar cost averaging. Just keep investing a fixed amount on a regular basis. It lets you buy more when prices are low.
Second, diversification. Please don't put all your eggs in one basket. And third, rebalancing. Use moments just like this one to get your portfolio back in line with your long-term goals.
Mr. Chen summed it up perfectly. He said corrections are when portfolios are built, not abandoned. And that is the choice every investor faces. Panic sellers are running for the door, while disciplined investors see a rare chance to build their long-term wealth at a discount.
And really, all of this, everything we've talked about, it boils down to one single, absolutely crucial idea that separates successful investors from everyone else. And it's this. Are you just reacting and gambling on short-term moves, or are you proactively and methodically building long-term wealth? That choice, right there, defines your entire outcome.
This was my favorite takeaway from the whole thing, honestly. It's a little bitter at first, right? Nobody enjoys watching their account balance drop. But in the long run, corrections are like spinach. They clean out the system, get rid of the excess, and are actually essential for the long-term health of the market and your portfolio.
So as we wrap this up, the final question is for you. The market just served up a big, healthy dose of spinach. The real test isn't what happened last month. It's what you decide to do with this opportunity right now. So are you ready?